Thank you very much, Peter. And I want to thank the organizers and you especially for the invitation to come to the conference and present my recently published book, The Puzzle of Sustainable Investment. I wrote this book to address what I perceive as some of the misconceptions or sometimes outright muddle thinking in the space, and also in reaction to the fact that when you read books, articles on responsible investing, when you tune into conferences, you very often hear extreme ends of a spectrum. ESG is either a silver bullet and it's a panacea for all the needs of that investors may have, and if we don't pursue it, something bad happens, or ESG is perceived to be a mistake, something that will actually destroy your portfolio if we pursue it. Maybe the whole markets will be affected, and eventually again something bad happens. And of course, neither of these extremes is correct. In investment practice, there are trade-offs. There are situations in which ESG investing is going to be quite relevant, might actually help you improve your risk-return outcomes. And there will be contexts in which taking on non-financial objectives is going to be, well, mathematically constrained, a bit of a headwind that you will face with your portfolio. The critical part, especially in practice, is going to be assess the trade-off, to be able to understand in which situations you may want to lean one way or the other, but also to recognize that very often the end investor will have a very clear and frankly non-negotiable need to build an allocation that will be defensible as an ESG aligned, green, socially oriented portfolio, for example. So I wrote the whole book to basically address these trade-offs and give people a sense of how investors actually solve them in practice. In doing so, I'm drawing from my experience, both as a professional investor, as somebody who has designed and managed sustainable portfolios, but also as a researcher, both in academic context, but also in practitioner settings where I actually assess various elements of the ESG puzzle overall. I also have served on multiple working groups or investor communities that actually debate these issues. So I think I have an appreciation for the breadth of views in this space. And maybe most importantly, I'm an educator. So I actually teach ESG investing. I have taught a course on ESG investing for a couple of years at Yale. For the past few years, I've been teaching it at Columbia University. And the book actually follows the structure and, broadly speaking, the sequence of topics that I teach in my course. Let me tell you a little bit about how the book is structured. In the first couple of chapters, I lay the foundation. I explain how to think about ESG in financial portfolios and actually also in financial markets. I start with what is perhaps the most frequently asked questions in ESG. Does ESG help or hurt? That question, as I explained, is actually not particularly well put. As I already mentioned, there will be situations in which ESG or ESG information will actually help, will improve financial outcomes. There will be others where ESG objectives, important though they are, may actually come at the cost of some financial performance. I also talk about how markets price ESG information. That's particularly important in the context of markets in transition. What happens when investors change their preferences, for example, exhibit more preference for ESG? When they change their beliefs, for example, they may decide that perhaps climate change is a more material risk factor for the underlying investments that they previously believed. And I talk about how actions of investors may actually give rise to some premia and then assess them with data in actual prices. Once we lay that foundation, we turn to the question of ESG data. I start with perhaps the most obvious ESG ratings, and I discuss how they may not outright predict risk and return, but they still are crucially important for investors. Investors need a common language. They need to be able to compare different portfolios, different managers, for example, on ESG metrics, or maybe compare individual companies of how well they do on ESG in a way that is replicable or verifiable across different managers, different portfolios. I also offer what I think is a different lens on ESG rating providers. So I argue that the best way to understand these institutions and the products that they offer is in the context of industrial economics. These are underlying firms that try to maximize profits. And once you view them as such, then some of the seeming puzzles about this space basically disappear. We can, for example, explain, I think quite easily, why the underlying ESG ratings may not be perfectly correlated. Maybe more interestingly, I then move on to more granular and often very creative indicators for specific E and S and G type issues. And I stress the importance of data due diligence. I explain how investors, researchers should view these indicators, what they should do to actually test them for potential power to predict returns or risks going forward. And I show that at least in some cases, there's actually a lot of evidence that suggests that some of these indicators may be quite helpful in understanding where the price or the risk of a given company is going forward. Throughout the book, and also in this part, I try to be as practical as I can. And I finish the chapter on ESG data with a natural case study that shows people how to actually derive or define your own ESG data. Once we deal with data, we move on to what is a very important objective for many responsible investors, that is impact. I define impact as using one's financial portfolio to change the economic actions of, let's say, your portfolio companies. I start by explaining why impact is possible in the first place and how impact may differ, or the channels of impact may differ, depending on what kind of financial stake you have in the company. Are you an equity holder? Are you a bond holder? Do you perhaps hold, some of the newer instruments such as green bonds? I also talk about how much impact is actually plausible. How much can you change the underlying company? But also, can your impact with the underlying company, can your engagement, voting and such, actually change the valuation of the company overall? And I back up my considerations with a number of case studies, including, for example, activist investing, green bonds that I already mentioned. I also discuss the recently popular investment movement of net zero portfolios, trying to achieve a net zero in the context of a financial portfolio. Finally, in the last part of the book, I go beyond traditional strategies. This is the cutting edge. We have talked about responsible investing in equities, in bonds for a couple of decades by now. In what I view as a sign of maturity, or at least growing maturity of this field, we are now changing the perspective from individual mandates, individual managers, to the overall investment programs that an investor may have, including not only, let's say, long-only equities or bonds, but potentially also hedge funds, maybe commodities, maybe derivatives that the investor may have in that overall portfolio. It's increasingly difficult to argue that some parts of the portfolio are not relevant or are not covered by the broad ESG considerations. But what is interesting is that the underlying issues are often very different. And there are plenty of nuances when it comes to the whether it's return or impact consideration when it comes to shorting or derivatives. I explained them, and I must say that this is also one area that is particularly divisive. There's plenty of very colorful exchanges you often hear at conferences or even in popular media when people talk about ESG and, let's say, shorting. I address these arguments. I tell you my view, and hopefully the arguments that I put forward will resonate with at least some of you. I finished the chapter with a discussion of a novel instrument that is increasingly popular in investment practice, that is carbon allowances, or at least futures of carbon allowances. And as I mentioned, throughout the book, I'm trying to be very practical. I'm trying to back up my arguments with case studies. And I think this approach has resonated with some of the early readers that that I've had. And in some cases, some of these readers actually agreed to give me some blurbs. I'm putting some of them on the back cover. There's a few more that are within the book as well. And I'm hoping that what resonated with them, this very, very frank kind of assessment of the underlying trade-offs, will actually resonate with you as well. My ambition is not to convince you that whatever views I have about ESG are necessarily correct. It's more to give you the tools and frameworks to be able to assess where the trade-offs may lie. We may disagree on that assessment, but hopefully we will agree on the underlying frameworks and on the underlying data that we will use to inform these trade-offs. And whether I achieve that goal or not, well, I think you will be the best judge. But in any case, it has been a pleasure to write this book, and I'm hopeful that it will be somewhat useful for you as well. Thank you very much.